Welcome to the DX Today podcast, where you get facts and no hype.
It's great to be back.
It is Tuesday, February 17th, 2026. And if you have looked at a stock ticker, a tech news feed, or, just the panicked Slack messages from your friends in Silicon Valley over the last 2 weeks, you know that something fundamental has broken.
Broken might be a bit strong, but the mood has certainly curdled. That's a good word for it.
Curdled is good. It's sour. I mean, for the last 3 years, really since the whole GPT-4 era kicked off, the line only went one way.
Up and to the right.
Up and to the right. It was a party. It felt like the roaring 20s of AI. And now we hit February 2026, and it feels like the lights just flickered on at 2:20 a.m. and everyone looks terrible.
It's the hangover phase.
Yeah.
Definitely. And I think when historians look back at the timeline of artificial intelligence, February 2026 is going to be circled in bright red ink.
Really? That's significant.
I think so. This is the moment the industry hit puberty.
Puberty. Okay, so that implies it's awkward, it's messy.
And necessary. Absolutely necessary. We are moving from what I call the pure story phase, where you could raise $100 million on a slide deck and a dream.
We saw a lot of that.
We saw so much of that. And now we're moving into the numbers phase.
Mm-hmm.
And the market is reacting, violently, because the numbers, quite frankly, aren't matching the stories. Not yet, anyway.
It feels like the parents finally came home from their vacation and decided to look at the credit card bill for the party their kid threw.
That is the perfect analogy, because for 3 years, the entire narrative was just Field of Dreams.
If you build it, they will come.
Exactly. If you build a data center, if you hoard all the H100s and the Blackwell chips and whatever comes next, the revenue will just inevitably follow. It was this pure story of exponential scaling loss.
The belief was just that if we make the model bigger, smarter, faster, the profits will just manifest out of thin air.
And investors bought that story. They bought it hook, line, and sinker. They rewarded it with, trillion-dollar valuations.
Mm-hmm.
Now, we are hitting what our sources are calling the wall of skepticism. And that's really our mission for this deep dive. We're going to unpack why big tech stocks are taking such a beating right now.
Okay.
But more importantly, we're going to explain the massive pivot that's happening just underneath the surface. We're moving from the era of giant language models to what's being called the agentic pivot.
The agentic pivot. It sounds cool, almost like a spy thriller or something.
Yeah.
But I have a feeling it's going to involve a lot of boring operational details and spreadsheets.
Well, the most profitable things in the world usually do.
That's fair. Okay, so before we get into the spy stuff and the profit margins, let's get the usual housekeeping out of the way.
Right. Just a quick disclaimer. We're analyzing trends. We're looking at commentary, market psychology. Nothing we say today is investment advice. It's not legal advice. It's not tax advice.
We're here to help you understand the landscape, the why behind the headlines.
Exactly. Not to manage your portfolio. So please, do your own research. Talk to a professional.
All right. With that said, let's walk into the fire. Segment 1, the macro view. You call this the wall of skepticism. My question is, why now? Why February 2026? We've had dips before, lots of them. Why does this one feel, structural?
Because the patience has evaporated. It's really that simple.
Mm.
To understand this, you have to look at what's being called the capex conundrum.
Capex, capital expenditure, the raw cash that companies spend on physical stuff, buildings, servers, all those expensive chips.
Correct. We are talking about the hyperscalers. So that's your Microsoft, your Amazon, Alphabet, Meta.
Yep.
And then you have the arms dealers, the primary one being NVIDIA. For 3 solid years, their capex spending has been, staggering.
Staggering is the word.
We are talking about hundreds of billions of dollars poured into custom silicon, these massive power-hungry data centers that need their own power substations. It's immense.
But for a long time, the market cheered that on. If Google announced they were spending another $10 billion on a new data center complex in Ohio, the stock would pop. It was seen as a badge of honor, a sign of strength.
It was. It was a signal of commitment. It was a company saying, look how serious we are about the future. But there's a limit. There's a limit to how long you can spend without earning. The free pass on capex is gone.
So what's the new question?
The new question is what investors are asking when they look at those billions leaving the bank account. And it's a very specific, very uncomfortable question they're asking. Is this margin-accretive?
Okay, let's break that term down for everyone. Margin-accretive.
It just means, is this huge spending actually making us more profitable for every dollar we earn? Or are we just bloating our costs to keep up?
Right. So if I spend $1 billion on a warehouse full of GPUs, am I going to get $2 billion in new high-margin software profit, or do I just get, well, $1 billion in new operating costs and a giant electricity bill?
Precisely. The fear right now, the thing that's haunting every earnings call, is that AI is becoming a cost of doing business rather than a true profit engine.
Like having a website or email, you just have to have it.
You just have to have it to compete. And if everyone has AI and it's incredibly expensive to run, you might just be raising your own costs to stay competitive without actually making more money than your rival.
That's the Red Queen race from Alice in Wonderland. You have to run twice as fast just to stay in the same place.
And Wall Street hates the Red Queen. They want to see the receipt. They want to see the return on investment, the ROI, and they want to see it now. Not in 2030, not in 2035. Now.
Wait, hold on. Let me just play devil's advocate here for a second. When the internet was being built, the fiber optics boom in the late 90s, companies spent billions, hundreds of billions, laying cable that went nowhere, at least at first.
A dark fiber.
Exactly. It crashed spectacularly. But eventually, that infrastructure did enable the entire modern economy. Isn't this just the necessary infrastructure build-out for the next phase of computing?
That's the optimistic view. And honestly, it's probably true in the long run. 10, 15 years from now, we'll look back and say it was obviously necessary. But the market lives in the short run. It lives quarter to quarter.
And right now,
the gap between money out, so infrastructure costs, and money in high-margin software revenue is at its widest point ever. That gap is a canyon, and that canyon is where the fear lives.
It feels like a canyon of fear right now, for sure.
And you can't forget the context of the broader economy. Interest rates. Money isn't free anymore, not like it was a few years ago.
Right.
When interest rates were near zero, you could afford to bet on a 10-year timeline. It was easy. In 2026, capital has a cost. If you're borrowing money, you're using shareholder capital, and you're burying billions in the ground in the form of data centers,
you better have something to show for it.
you better have more to show for it than a chatbot that summarizes your emails slightly better than the last version. If you don't, investors are going to revolt. And that's what we're seeing.
So the macro vibe is just show me the money, period. Let's zoom in on the specific companies because they're not all in the same boat, are they? We've got a report card to go through. Let's start with who used to be the class president. Microsoft.
Microsoft is in such a fascinating and I would say precarious spot. For the last few years, they were the safe bet. The bluest of the blue chips in AI.
Why? What was the thesis?
It was a simple three-part story. One, they have the enterprise contracts already. They're in every business on the planet. Two, they own the operating system of business, which is Office. And three, they had the golden ticket, the exclusive partnership with the biggest, most advanced frontier model lab.
It seemed like an unbeatable trifecta, so why is the stock wobbling now? What changed?
What changed is that the market is starting to peel back the layers of the onion on Copilot, and they're asking some hard questions.
Copilot, I mean, it's everywhere. It's in everything. I can't open a Word document or a PowerPoint without it offering to write the whole thing for me.
But here's the question. Are you paying for it? And if you are, is your company paying for it? And more importantly, is it fundamentally changing how you work, or is it just a nice-to-have novelty?
I use it sometimes for brainstorming, maybe, but I would not say it has revolutionized my day. It hasn't taken work off my plate, really.
And that is the multi-billion, maybe trillion-dollar problem. We are seeing serious questions emerge about the unit economics of Copilot.
Okay, so the cost versus the price.
Precisely. Remember, every single time you ask Copilot a question, every time it generates a paragraph for you, Microsoft has to fire up a very expensive GPU in a data center somewhere to generate that answer. That costs electricity. It costs water for cooling. It costs compute wear and tear.
Which is completely different from the old version of Microsoft Word, which just ran on my laptop and cost Microsoft exactly $0 after I bought it.
Exactly. The marginal cost of usage for traditional software is zero. The marginal cost of usage for AI is high. So if you pay them, say, $30 a month for the service, but you use a huge amount of compute, you might actually be an unprofitable customer for them.
Or the other way, right? If I don't use it enough to feel like I'm getting my $30 worth.
You churn. You cancel the subscription. It's an incredibly delicate balance to strike. And there's a deeper, more existential threat for Microsoft, too. It's what people are calling the legacy stack threat.
Explain that. What's the legacy stack?
Microsoft's entire empire is built on 30, maybe 40 years of legacy code, and, more importantly, legacy user interface paradigms. Think about it. Files, folders, the ribbon at the top of the screen. Menus.
The start button.
The start button. They're trying to layer this revolutionary new AI technology on top of that old, creaky structure. It's like trying to bolt a jet engine onto a horse-drawn carriage.
It works, kind of, but it's clunky and maybe not the best way to travel.
It's clunky. And the risk, and this is what the really smart money is worried about, is that an AI-native rival comes along.
A company that doesn't have all that baggage, a clean sheet of paper.
Exactly. A company that builds a new productivity suite from day one, assuming the AI does most of the work. No files, no folders, no clicking through menus. You just state your intent. Make me a presentation about our Q4 sales numbers, and the system executes it.
And if a startup can build a workflow like that, one that's genuinely 10 times faster because it doesn't have to respect the old office paradigm.
Then Microsoft's famous moat starts to look less like a defense and more like a swamp that they're stuck in.
That's a huge strategic vulnerability. It's the classic innovator's dilemma. They can't just delete the start button tomorrow because a billion people know how to use it and their businesses depend on it.
They're trapped by their own success. And while they're spending years figuring out how to carefully integrate this new tech into their old tech, agile competitors are building the future from scratch.
Wow. So the safe bet is maybe not looking so safe after all. Let's move on to the rock star, the diva of the whole show, NVIDIA, the company that literally sells the shovels in the AI gold rush.
NVIDIA has been the proxy for AI enthusiasm, the avatar for the entire movement. If you believed AI was real and was the future, you just bought NVIDIA stock, and they executed perfectly, flawlessly even.
So why on earth is there skepticism now? Are they not selling enough chips?
They're selling plenty of chips. The problem is that they were and still are priced for perfection.
Which means what exactly?
Which means the stock price was so high, it mathematically assumed that NVIDIA would not only continue to dominate its market, but would also continue to grow at an explosive, frankly, exponential rate for the next 5 to 10 years.
Which is, well, it's physically impossible. You run out of customers eventually. At some point, everyone who needs a chip has a chip.
Precisely. The law of large numbers always wins. So when you're priced for perfection, even a great earnings report feels like a failure because the market was expecting a miracle.
A disappointment.
A huge disappointment. We're starting to see signs of demand saturation in some specific markets. But the bigger, longer-term threat to NVIDIA is actually a technical one: efficiency.
You mean the software is getting better at using the hardware?
Yes, dramatically better. 2 years ago, if you wanted to run one of these massive frontier models, you needed a giant cluster of their top-of-the-line H100s. It was the only way.
Okay.
Today, software engineers and researchers have figured out brilliant ways to compress these models. They're using sophisticated techniques like quantization and distillation.
Making the models smaller and smarter, essentially.
Exactly. Making them more efficient. Which means you can run them on cheaper, older hardware. Or, more critically, you need fewer of the new, expensive chips to do the same amount of work.
So if software efficiency improves by, say, 50%,
then NVIDIA potentially sells 50% fewer chips to achieve the same outcome. That is the nightmare scenario for their growth curve. It puts a ceiling on their addressable market.
it's kind of ironic, isn't it? The better the AI software gets, the less of the super expensive hardware it might need.
It's the paradox of efficiency. And that's not even their only problem. We're seeing alternative architectures pop up everywhere. Google has its TPUs, which are getting very good. Amazon has its custom Trainium and Inferentia chips.
The hyperscalers themselves, their biggest customers, are trying to become their competitors.
They are trying desperately to stop paying the NVIDIA tax. They're spending billions to build their own custom silicon that's perfectly tuned for their own workloads.
So, if you're NVIDIA, you're facing a market that's getting saturated. Software that's making your product less necessary, and your biggest customers trying to replace you.
It's the trifecta of what Wall Street calls structural derating. And let me be clear, this doesn't mean NVIDIA is a bad company. They're a brilliant company. It just means it might not be a $10 trillion company, which is what the stock price was implying.
Got it. Okay, let's hit the third giant, Amazon.
Amazon is unique. They're in a category of their own because historically, they've been the capital junkies.
Yeah.
Jeff Bezos famously reinvested every single dime for 20 years, and Wall Street loved it.
Right. The story was always, they're building the future. Don't worry about profits today. Think about Prime and AWS tomorrow.
And it worked.
Yeah.
But this time, the margin squeeze is undeniable, and it's happening in their most profitable division, AWS. Amazon is fighting a war on two fronts. On one front, they have to build out these massive, expensive AI data centers just to keep up with Microsoft and Google. That costs billions.
Okay, that's the cost side.
Right. But on the other front, their customers, all the startups and enterprises using AWS, are getting extremely price sensitive.
They want cheaper cloud bills. Everyone wants a cheaper cloud bill.
They do. And specifically, they want cheaper inference. Now, we keep using this word, so let's define it clearly. Training is the process of teaching the AI model, feeding it the entire internet to make it smart. Inference is the process of using the model that's already been trained, so asking it a question.
Okay, so training is like going to college for 4 years. Inference is having a job and answering questions all day.
That is a great analogy. Training is a massive one-time or infrequent cost. Inference happens millions of times a second. And the market is shifting heavily from a focus on training to a focus on inference.
Because people want to use the apps now, not just build the models.
Exactly. And inference is a commodity game.
Yeah.
Customers are saying, look, I don't care if it's an Amazon chip or a Google chip or an NVIDIA chip. I just want the cheapest, fastest answer to my query.
And that competition drives prices down.
It drives prices down, while their internal costs for energy and building data centers are driving expenses up. That is the squeeze. Amazon is stuck right in the middle, and Wall Street is watching like a hawk to see if they can protect their legendary AWS margins.
So just to sum up this section, we've painted a pretty bleak picture. Microsoft is heavy and weighed down by its legacy. NVIDIA is peaked and priced for perfection. Amazon is squeezed between costs and customers. Is this it? Is the AI bubble finally popping?
No, I don't think so. The hype bubble is popping, the utility phase, the real work is just getting started. And this brings us to the absolute core concept of today's deep dive, the agentic pivot.
Ah, yes. I promised everyone we'd get to the spy stuff.
It's a bit less James Bond and a little more super efficient executive assistant.
Okay, I'll take it. Define it for us. What is the agentic pivot?
At its heart, it is the industry-wide transition from bigger models to smarter systems.
Unpack that phrase. Bigger models to smarter systems.
For the last 3 years, the main contest was just parameter count. My model has 1 trillion parameters.
Well, mine has 2 trillion.
Right. It was a pure size contest. The underlying assumption was that a bigger brain is always a better brain. That if we just keep scaling up, we'll get to AGI.
And now we're realizing that's not the whole story.
And now we're realizing that a bigger brain doesn't necessarily do the work better if it doesn't have hands and eyes. We are moving from the era of chat, just generating text, to the era of executing actions in the real world.
So an agent is an AI with hands.
Metaphorically, yes. It has access to tools. An agent is a system that isn't just a brain in a vat. It's a system that can use software, browse the web, access a private database, call an API, and make decisions in a sequence to complete a goal.
Let's get really concrete with this. The source material had a great example about handling customer refunds. Can you walk us through the old way versus the new agent way?
Absolutely. So the old way, the chatbot way, is what we basically has now. You go to a retail website, a chatbot pops up, and you type, I want to return these shoes. The chatbot, which is just a language model, replies, I can help with that. Here's a link to our returns policy page.
And then I have to click the link, read the policy, find the right form, fill out the form, print the label.
Exactly. The chatbot gave you information. It was a slightly better search engine. It didn't do any work.
Right. It pushed the work back onto me.
Now contrast that with the agentic way. You go to the same site, you type return these shoes, the agent looks at your account, identifies the order number from your email history, it logs into the company's inventory system to check if the item is returnable. It connects to the UPS API to generate the shipping label. It initiates the bank transfer for the refund, putting it in a pending state. It schedules the UPS pickup at your house. And then, and only then, it comes back to you and says one word. Done. Pickup is Tuesday at 2 p.m.
That's a night and day difference. That's a fundamental shift.
It moves the human from being the router of information and the doer of tasks to being the manager of outcomes. You just state the goal, and the system figures out the steps.
And from a business perspective, from an ROI perspective, that's where all the money is.
100%. Information is cheap. Labor is expensive. If I sell you a chatbot that gives your customers information, I can charge you a little bit of money for that. But if I sell you an agent that replaces the work of 3 full-time customer support reps,
I can charge you a lot of money for that.
You can charge a lot of money for that. That is the tangible, measurable ROI that investors are now demanding.
This is why we call it the era of ROI. It's not about potential anymore. It's about performance.
Exactly. The companies that can build reliable agents systems that can actually be trusted to do real work are the ones that will justify these massive valuations. The companies that just build slightly better chatters are going to see their valuations go to zero.
But wait, isn't building these agents way, way harder? It sounds incredibly risky. I mean, if a chatbot hallucinates, it just tells me a funny lie. If a refund agent hallucinates, does it accidentally delete my company's database?
That is the massive technical hurdle that the entire industry is working on right now. Reliability. You've hit on the key problem. A chatbot that is 90% accurate is fun and mostly useful. An agent that is 90% accurate is dangerous and unusable.
Imagine a banking agent that's only 90% accurate with wire transfers.
It's a complete disaster.
Yeah.
So the whole focus of the top engineering talent is shifting. It's no longer about making the models smarter in a creative sense or more poetic. It's about making it controllable, verifiable, and safe.
So how do they do that?
We're seeing a huge rise in what are called evaluations or evils. These are other AI systems whose only job is to test and check the work of the primary agent before it takes an action.
So the software stack is getting much more complex. It's not just a single prompt and a single response anymore.
No, not at all. It's a loop, a constant cycle. The agent has to plan the steps, then execute a step, then check the result, then correct its plan based on the result, and only then can it finalize the task. That multi-step reasoning and checking loop is the core architecture of 2026.
And this shift also helps explain why the war over model size, the parameter count, is starting to cool off.
It connects perfectly. Think about that loop plan. Execute, check, correct. For a single complex task, an agent might need to run that loop or call a model 50 or 100 times.
Okay.
If you are using a massive, expensive, slow, trillion parameter model for every one of those steps, the cost is absolutely prohibitive. It would cost $5 to process one refund. But if you have a swarm of small, fast, specialized models, one for planning, one for checking code, one for understanding customer intent, the whole system becomes economically viable.
So the agentic pivot actually reinforces the need for those smaller, more efficient models we were talking about in the NVIDIA segment. It's all connecting.
It's a complete ecosystem shift.
Yeah.
We're moving from the idea of one giant genius brain to the idea of a swarm of efficient, supervised workers.
Okay, so let's follow the money then. This is a huge technical shift. If the technology is shifting from models to agents, how are the investors and the startup world reacting? You mentioned earlier that startups are in a squeeze too.
The startup world is going through a brutal reality check. In 2024 and 2025, if you had AI in your pitch deck on a couple of smart founders, VCs would literally throw money at you. Valuations were, sky high.
The unicorn factory was in full swing.
In full swing. But now, the public markets, the Microsofts, the Googles, have derated. Their stock prices and their multiples are down, and that lowers the ceiling for everyone else. If Microsoft is only trading at, say, 20 times earnings, a little startup can't go to a VC and claim they should be worth 100 times their revenue.
It's valuation compression. It flows downhill from the public markets to the private ones.
It does, and it leads to the dreaded down round. We're seeing startups that raised money at a $1 billion valuation in 2025 having to go back to investors now and say, actually, we need more money, but we're only worth $400 million today.
Ouch. That is so painful for the founders, for the employees who have stock options that are now worthless.
It's crushing. It completely crushes morale. And it wipes out the equity of the early employees and even some of the early investors. So what we're seeing is a talent migration. The best engineers are leaving some of these flashy but underwater startups, and they're moving to, anywhere that can pay them in actual cash, not just lottery ticket stock options.
What about the classic escape hatch? M&A, mergers and acquisitions. Usually when startups struggle, big tech swoops in and buys them up.
That used to be the playbook.
Yeah.
It was a reliable exit. But two huge things are blocking that path right now. One is simple. Big tech has less funny money stock to spend because their own stock prices are down.
Right.
A deal that made sense when your stock was at 400 doesn't make sense when it's at 250.
And the second thing?
The second thing is much bigger. The government, the regulators,
Right.
the FTC in the US, the CMA in the UK, the EU. They are watching the AI space like hawks. They are terrified of one or two companies achieving a monopoly. If Google or Microsoft tries to buy a major AI startup today, the antitrust lawsuit lands on their desk the very next day. It's a non-starter.
So the startups are trapped. They can't IPO because the market is cold and skeptical. They can't sell to a big company because the regulators are watching. And they can't raise more money easily because the valuations are down.
It is a very tight box. And the only way out of that box is revenue. Real, profitable recurring revenue.
Which brings us right back to unit economics and the agentic pivot. It's survival of the fittest, and fitness is measured in profit.
But here is the major twist in the story. While the U.S. public market is hyperventilating about quarterly earnings and profit margins, there is another very powerful group of players on the field who simply do not care about any of that.
Who are we talking about?
We're talking about the geopolitical actors,
Yes.
specifically sovereign wealth funds.
So we're talking the Middle East, Saudi Arabia, the UAE.
Them, primarily, yes, and also state-backed programs in places like India, and of course state-aligned actors in China. You have to understand the fundamental difference in their timeline and their motivation.
Yeah, so
A hedge fund manager on Wall Street is thinking about the next 3 months, about the next quarterly earnings report. The public investment fund of Saudi Arabia is thinking about the next 30 years.
they're not playing for a stock bump. They're playing for a post-oil world.
Correct. They view AI not as a stock trade, but as critical national infrastructure. It's on the same level as roads, electricity, or national defense. It's a matter of sovereignty.
So while a company like Microsoft might slow down its data center construction because their stock dropped 10%.
These sovereign funds are saying, great, we will take the chips you don't want, we will fund the power plants, keep pouring the concrete. We're witnessing a physical shift in the center of gravity of AI infrastructure.
This is the geopolitical counterweight that was mentioned in the notes.
Yes, and it's driven by physics and politics, not
Yeah.
by stock prices. AI is incredibly energy hungry. Who has the cheapest, most abundant energy in the world?
The Middle East.
AI requires massive long-term capital. Who has the most liquid capital right now looking for a place to go?
Sovereign.
And AI requires huge plots of land and rapid permit approval for things like power and water. Who can approve a permit for a new nuclear power plant in 24 hours? An authoritarian government or a highly focused development state?
Unlike here in the U.S., where building a new power line can take a decade of environmental reviews and legal challenges.
Exactly. So the risk, and this is a very, very serious risk for the West, is that while our public companies pause to fix our margins and please the shareholders for a few quarters, the foundational infrastructure of the next century's economy is being built somewhere else.
We're sitting here worried about the P&L statement for Q2 2026, and they're worried about their country's digital sovereignty in 2050.
And if the brain of the future, these massive nation-scale training clusters, physically resides in a jurisdiction that isn't the U.S. or Europe, that fundamentally changes the geopolitical map for the next 100 years.
That is a very sobering thought. The stock chart is not the territory.
Never. The stock market is a voting machine in the short term, but a weighing machine in the long term. And in the long term, physics, energy, and infrastructure always win. If you have the power and you have the compute, you have the advantage. Okay. Wow. So let's try to land the plane here. We've covered the market crash, the massive tech pivot to agents, the startup squeeze, and this huge geopolitical race happening in the background. It's February 2026. What is the path forward for the rest of this year? What does winning look like now?
The theme for the rest of 2026 is AI adulthood.
Growing up is hard, as they say.
It is, but it's good. It's necessary. The industry is putting on a suit and tie. We are done with the magic trick phase of AI. No more, look, it wrote a poem about my dog in the style of Shakespeare.
Now it accurately processed 10,000 invoices with no human intervention and saved the company $200,000.
Boring, beautiful, profitable. That's it. The winning formula for 2026 is that simple. Build systems that do real, measurable work.
So if you are a leader at a big tech company, what's your mandate? Focus on efficiency. Ruthlessly. Cut the bloat from your research projects. Show investors a clear, believable path to monetizing all that capex you just spent. Move your best people from experimentation to deployment.
And if you're a startup founder,
Survive. Just survive. Get to cash flow positive as fast as you possibly can. Forget about the unicorn valuation. Just focus on building a good, sustainable business. Solve one specific, painful problem for one specific type of customer who is willing to pay you for it today.
and what about for you, the listener, the people who are engineers, product managers, marketers working in these companies?
My advice would be to ignore the daily gyrations of the stock price. Focus on the utility of what you're building. Ask yourself, honestly, is the tool I'm building actually solving a real-world problem, or is it just a cool demo? If it solves a real problem, you have a future. If it's just a demo, you're in trouble.
So the final assignment for everyone in the industry is just make the numbers add up.
It's the only thing that matters now. Gravity's back.
I love that. It's such a grounded and frankly refreshing conclusion after 3 years of what felt like absolute mania. Make the numbers add up.
It's the gravity of economics. It always, always wins eventually.
Okay, so to recap our journey today for everyone, we started at the wall of skepticism, the great AI hangover of early 2026. We saw how the giants, Microsoft, Nvidia, and Amazon, are all facing this difficult show me the money test. We then defined the agentic pivot, this critical move from just chatting to actually doing. From there, we looked at the capital crunch in the startup world, this tight box they're stuck in. And finally, we looked over the horizon at the geopolitical long game, where the physical infrastructure of AI is quietly moving to where the energy is cheap and the patience is deep.
That's a great summary of a very messy, very important moment in time.
And now, as we always do, we like to wrap up by leaving you with a final provocative thought, something to chew on that wasn't explicitly in our discussion but grows out of it. What's on your mind?
For me, it goes right back to that geopolitical tension. We talked about how the West, how Wall Street might pause or slow down investment because of these short-term market fears.
Right. Get the house in order, fix the margins.
Exactly. My question to you is this. If the intelligence of the future, these foundational models, are trained on hardware that is owned by sovereign wealth funds, powered by their national energy grids, and physically hosted on their land, does that mean the values of that intelligence will inevitably shift as well?
Oh, okay. That's deep. We tend to assume AI is either neutral or that it will naturally absorb Western democratic values because that's where it was born.
But an AI learns from its data, its environment, and its constraints. It is shaped by its creators and its owners. If the fundamental infrastructure owner changes, does the alignment of the AI change too? Are we, in the West, inadvertently trading long-term cultural and ethical dominance for short-term profit margin protection?
Who owns the brain, owns the culture of the future?
It's a question that should be keeping policymakers, not just CEOs, up at night.
Well, on that absolute cliffhanger of a thought, thank you for listening to this deep dive. We hope it helped you make a little more sense of the red numbers on your screen and the new reality of AI in 2026.
Thanks as always for listening.
We'll see you next time. Use the knowledge, ignore the hype.